Good morning, this is your DealBook briefing for Monday, July 27, 2026. I'm Andrew Ross Sorkin, and we've got a packed edition today, from Nvidia stepping into a role some are calling the central bank of the AI economy, to a renewed pause in US-Iran hostilities that's moving markets, to short sellers circling Elon Musk's empire once again. Let's dive in. There's a phrase making the rounds in Silicon Valley and on trading desks alike: Nvidia as the central bank of the AI economy. The latest evidence? A Wall Street Journal report that the chipmaker is brokering a roughly $250 billion guarantee for OpenAI's immense new campus in Ohio. Now, underwriting debt for unprofitable partners is undeniably risky. But it also offers the broader AI ecosystem a form of cheap capital that traditional credit markets simply refuse to provide. This playbook has deep historical roots. Almost every generational infrastructure leap has relied on hardware titans to co-sign their buyers' credit. Think British steelmakers funding 19th-century American railroads, or General Electric underwriting early power utilities. The track record is mixed. It successfully built America's electrical grid and, later, broadband internet. But it also incited devastating vendor debt crashes during the 2001 telecom bust. The question now is, what will it be this time? At the center of this story is Jensen Huang. His first post on X took aim at one of the biggest debates dividing big tech, and his words continue to reverberate across Silicon Valley and beyond. The stakes are high for Huang, whose chipmaker Nvidia is helping power the AI boom. His Big Ten contention that AI can be developed safely on so-called open-source models as well as closed ones has major implications for policymakers and investors, and could completely upend the AI economy. Watch for it to be a major discussion point this week as Amazon, Meta, and Microsoft weigh in on their latest quarterly results. Here's the recap. In Huang's post, which appeared Friday and has racked up more than 60 million views, he shared a letter also endorsed by tech and investment giants like Andreessen Horowitz, Meta, and Microsoft. It argued that open models would accelerate innovation and strengthen security. The world needs both frontier closed models and frontier open models, Huang wrote. Frontier labs like Anthropic and OpenAI argue the opposite. Some of the technology is too powerful for an open-source approach and should be limited to controlled environments like theirs. A reminder, Nvidia has skin in the closed camp. It's been a major backer of Anthropic and OpenAI, and is reportedly in discussions to guarantee the $250 billion for OpenAI's Ohio data center project. Others have echoed Huang's comments, including Satya Nadella of Microsoft, Mark Zuckerberg of Meta, Sundar Pichai of Alphabet, and Demis Hassabis of Google DeepMind. Why would Huang and other tech execs side with open models? Analysts say easier access to open-source AI should speed up the technology's growth and drive demand for Nvidia's chips or Microsoft's cloud. But new competition from Beijing has intensified the debate. Chinese startups Z.AI and Moonshot AI have recently released open-weight models that are powerful and relatively cheap, a potential antidote for corporate sticker shock over what some are calling token maxing. But Anthropic and OpenAI claim foul play. They accuse Chinese startups of copying their technology via a technique called distillation. This clash has spilled into the pages of the New York Times, where Mike Isaac, Kate Conger, Anna Swanson, and Megan Tobin report that for years, a philosophical divide over how AI software should be created has split Silicon Valley technologists, and this week, that argument reached a boiling point. On one side are leading AI companies like Anthropic and OpenAI, which claim some AI models are too dangerous to be developed in the open and must be tightly controlled by businesses like themselves for safety. On the other is the rest of the tech industry, arguing that open models accelerate innovation and that restrictions would cede ground to China. Trump officials appear to be walking a fine line. They want to avoid stifling AI innovation at home while playing tough against the threat of international companies stealing U.S. technology. In a post on social media, Treasury Secretary Scott Bessent threatened Chinese companies with sanctions if their creations cross the line into IP theft. The bigger question, as my colleagues and I explore in a companion newsletter, will Washington move to block Chinese open-weight models from the US? And will this become a new chess piece in the broader tech Cold War? Trump and Xi are expected to discuss AI regulation ahead of their meeting on September 24. In related news, SoftBank's $40 billion bridge loan for its OpenAI stake drew 21 new lenders, suggesting investor appetite for closed AI models remains strong, according to Bloomberg. Shifting gears to Hollywood, the blockbuster run continues. Christopher Nolan's Homeric extravaganza The Odyssey brought in $87 million in North American ticket sales over its second weekend, putting its global take so far at almost $640 million, according to Deadline. With the successes of The Odyssey, Toy Story 5, and Michael, Hollywood appears on track to reach $10 billion domestically for the first time since the coronavirus pandemic. Meanwhile, a Chinese chipmaker is cashing in on the AI boom. Changxan Memory Technologies, known as CXMT, rose about 470% on its first day of trading today. It makes memory chips needed for the AI build-out and became the most valuable company on the Shanghai Stock Exchange. Steve Lohr, reporting from Seoul, notes that CXMT had already completed Asia's largest initial public offering this year, which 2 weeks ago valued the company at more than $85 billion. Investors catapulted the chipmaker's valuation on the Shanghai Exchange to more than $480 billion at closing, well ahead of the Industrial and Commercial Bank of China, the previous leader. CXMT's IPO gains underscore Beijing's push to develop domestic AI suppliers to rival Western giants. This week, the Fed and earnings will dominate markets. Wednesday is decision day for the central bank, as the debate around inflation intensifies in the face of volatile energy prices. While big tech earnings will get plenty of attention, investors will also get a glimpse into the health of consumers, with Coca-Cola reporting tomorrow, Procter & Gamble on Wednesday, and MasterCard on Thursday. Finally, the Personal Consumption Expenditures Price Index for June, the Fed's preferred inflation measure, is set for release on Thursday. Now to the Middle East. Global markets are rebounding today as investors cheer a pause in fighting between the US and Iran that lasted through the weekend. The bulls see the apparent de-escalation as a sign that Washington and Tehran could give diplomacy a chance to reach a more lasting peace that also lessens the war's blow to the global economy. But bears could point to signs of a slowdown in ship traffic through a vital Red Sea trade route, after the Houthis, an Iran-backed militant group in Yemen, attacked Saudi oil installations in the region, Reuters reported today. The latest numbers, Brent crude, the international benchmark for oil, has fallen nearly 8% to $89.25, after surpassing $100 a barrel on Thursday and Friday. S&P 500 futures are rallying, as are bonds and cryptocurrencies. The yield on the 10-year Treasury, which has been highly sensitive to fluctuating oil prices, fell to 4.64%. Rebecca Elliott and Jenny Gross report that oil prices fell and stocks wavered on Monday as fighting paused. The relative calm left investors hopeful that more energy might soon start flowing from the region, even though ships still faced dangerous conditions. Energy prices had surged throughout most of July as the ceasefire fell apart. Then last week, oil topped $100 a barrel after the Houthis broadened the conflict by threatening a blockade against Saudi Arabia in the Red Sea. But President Trump's decision to hold off, at least temporarily, on a major escalation brought renewed optimism among traders about a resolution. Is the pause being driven by the markets? Energy prices had soared after the US and Iran resumed exchanges of attacks, prompting new inflation fears that could compel central bankers to raise interest rates. The average price of gasoline in the US remained at $4.11 today, according to AAA, nearly $1 above where it was at this time last year, an issue that could add to voter discontent before the midterm elections. Or is it more about the munitions? Eric Schmidt and Jonathan Swan report that President Trump has set aside, at least for now, plans to sharply escalate the American military assault against Iran, with particular concern that intensifying the war could dangerously drain the Pentagon's already diminished stockpile of Patriot anti-missile interceptors and other air defense munitions in the Middle East. The threat to interceptor stockpiles is one of many considerations that have made a return to major combat operations a hugely risky endeavor, administration officials say. Investors may be getting a case of déjà vu. Businesses and market observers have been wondering whether the economic fallout from the war in Iran would persuade President Trump to seek an off-ramp to hostilities. He did so last year when his trade war roiled the bond and stock markets, giving rise to the market shorthand of taco, Trump always chickens out. But pinning hopes on a Tehran taco may be misguided. Paul Donovan, the chief economist for UBS Global Wealth Management, wrote to investors this morning that there are two key differences. The trade war was largely unilateral, but the Gulf War needs Iran to act too. The oil price drop required Iran to cease strikes on U.S. targets. The trade war directly affected the U.S. economy, not the global economy. Global trade is at a record high. Erratic oil prices have a more global direct impact. My colleagues and I explored this taco question in today's companion newsletter. President Trump's signals that U.S. strikes on Iran could conclude soon appear intended to soothe a market rattled by soaring oil prices. This raises a provocative question: does the S&P 500 now dictate U.S. foreign policy? Also in the mix, Bill Ackman officially filed to take his hedge fund public. Now to a story that's been remarkably profitable for a certain breed of investor. Short sellers are circling Elon Musk's companies again. Short sellers are having a rough year so far, down more than $200 billion collectively, but they continue to go all in on one sector. In recent months, traders eyeing a market swoon have increasingly bet against the giants of the artificial intelligence race as worries about a bubble grow. And one target has been especially profitable: SpaceX, Elon Musk's rocket and AI company. Here are the numbers. According to S3 Partners, those that have wagered against SpaceX have cleared nearly $7.3 billion in mark-to-market profits since the company listed in a record-breaking IPO last month. Shorts against SpaceX have surpassed $26 billion. That's a fraction of SpaceX's $1.5 trillion market cap, but it is roughly 35% of the entire SpaceX float, shares available for investors to trade. SpaceX has become the second most profitable company to short this year, according to S3 Partners. Tesla is number one, with short sellers of the electric vehicle maker up nearly $9.1 billion in mark-to-market profits this year. We've seen continued SPCX short selling since its inception, Iyer Dusanowski, a managing director at S3 Partners, told DealBook over email, referring to SpaceX by its ticker symbol. The bets against SpaceX are especially bold. The company secured fast-track inclusion on the Nasdaq 100 index of tech heavyweights and on other big indexes, generating excitement and alarm among investors and fund managers. Nasdaq, FTSE Russell, and CRSP changed their rules before SpaceX's IPO, making it possible to bring in SpaceX. Worth watching, SpaceX reports quarterly results on August 4th. 2 days later is the first lockup expiry date, when some SpaceX pre-IPO shareholders can begin selling the stock. That could add volatility to a stock that's down nearly 15% from its listing price. Musk, who has sparred with Tesla short sellers in the past, has said that betting against SpaceX could backfire on investors. Shorts are targeting other AI heavyweights, too. Tech giants with a major stake in AI, think hyperscalers like Alphabet, Amazon, and Microsoft, and chipmakers like Broadcom, Micron, and Nvidia are among the top 10 most shorted stocks this year, according to S3 Partners. The mounting bearish bets are another headwind as investors grow increasingly wary of the sector's AI spending spree. Let's move to the speed read. In deals, Blackstone is opening an office in Kuwait after joining with Brookfield Asset Management and KKR on a $16 billion lease deal involving the country's oil pipelines. Brown-Forman, the spirits company that owns Jack Daniel's whiskey, has rejected an unsolicited $15 billion takeover offer from Sazerac, after its fellow bourbon maker asked it to reconsider. And Carlyle and Bain Capital are reportedly the last investment funds bidding on Wealth Enhancement, a wealth management platform with nearly $160 billion in client assets. In politics, policy, and regulation, a New York Times investigation finds that Trump is pushing nuclear energy, including a Saudi deal, and his family and supporters could benefit. In some cases, no direct line can be drawn from the president's domestic nuclear agenda to his family or close allies, but they have overlapping business ties that could position them for gains. Meanwhile, the Democratic Party is so short on funds that it is reportedly asking some vendors not to send bills until after the midterm elections. Shane Goldmacher and Reed J. Epstein report that the Democrats should be well positioned to make gains in this year's midterms, but inside party headquarters, every week brings paranoia, worries about money, and on occasion, emotional eruptions. The bookkeeping maneuver, described by 3 people briefed on it, is the latest sign of financial duress for the Democrats. Best of the rest, unreleased footage from a documentary film project reveals Lindsey Graham's push for war with Iran. Look what we've done here. I almost cried, one moment captures. And a CNN piece asks, what a $15 pint of ice cream says about the economy. That's your DealBook briefing for Monday, July 27th. We'll see you tomorrow. If you have thoughts or suggestions, email us at dealbook@newyorktimes.com.